our solvency, as I think I said in March when I came on just ahead of our decision to withdraw the dividend proposal, does remain strong. We announced about a month ago that it was 182% following the first wave of the coronavirus issue. So we acted to pause the dividend really in the face of quite strong regulatory input, both from EIOPA and the PRA, and also out of being cautious and just looking forward to the uncertainty, and that with an eye on the long-term health of the company, that we paused dividends, and we'll be coming back to that, as we said, in the fourth quarter.
I mean, that was a heavy hint, if you don't mind me saying, and perhaps that's what you meant to do, Jason, that the PRA was perhaps, again, what it does on the tin. It was prudent at the time to have a think about dividends and make sure the financial stability was in place as well. But, I mean, I just got the impression for you that the dividend's safe and that you will be paying that dividend.
Look, the company is in a sound financial position. We've got good capital and good liquidity. And I think you're absolutely right. The word prudent was very much on our minds, and I'm sure it was very much on the regulators' minds when they made those comments. As you would have seen, they publicly welcomed our decision, which gives you a sense of the sort of conversations that we've been having in the run-up to that. So we're not concerned about the financial health of the company. We are concerned about the macroeconomic outlook, and we've made a prudent decision.
Yeah, I just wanted to pick up on that, Jason. I mean, what are the impacts going to be going forward then? And obviously it's germane to what you do to the dividend with the current investment spread, because where the central banks have got rates, and the UK is the same on this, and with other companies in the market dropping dividend payments, what pressure is that putting on the side of your operation that has to invest for return?
Yeah, look, it's a challenge, and it's something we've been dealing with for many years. We've had low rates in Europe, particularly, going back many years, and unfortunately for the insurance industry, they're going to be here to stay. So we've been adapting the business model to make sure that we can offer relevant products to customers. The traditional with profit type products, which do require some decent government bond yields, really to provide a decent return to customers, are challenging. We've been talking about that for some time. With the rates, with the 10-year euro swap now negative, and it's been there for about a year, that does pose other challenges. So, we are working with distributors to make sure that we've got the products that are more relevant to a very low interest rate yield.